Let's cross over live to Tokyo and talk to Jesper Koll, head of Japan equity research at JPMorgan. Jesper, good to have you on the program once again. But first, let's talk about this talk of merging between the two big exchanges, Osaka and Tokyo. Does this make sense to you at all?
No, it makes perfect sense. It's been on the burner, basically for a couple of years already, and you sort of come in ebbs and waves here. So we see where we're going. The interesting thing is whether it's, the merger of the stock exchange or the potential merger of the stock exchanges, whether it is corporate action looking for more aggressive M&A overseas. Corporate Japan is waking up from its slumber. You do get restructuring. You do get a focus on core competence. At the end of the day, Japan is getting better.
Okay, that's right, and they're looking for scale as well, Osaka and Tokyo, to try to compete with the likes of London and here in Hong Kong. So do you think this is a done deal in your view, considering they're in these final merger talks as we've been reporting?
Look, the negotiations are obviously still continuing there, but it does make sense, and I personally believe that in the end, we'll end up with a unified market.
Okay, well, there you go. Look out for it. So Jesper, let's talk about corporate Japan itself. As we mentioned, the Japanese currency proving to be a double-edged sword. It's hurting profit margins, but guess what? It makes acquisitions cheap, like what fast retailing is talking about. So in the end, I guess, how do corporates, how do they respond to this strong currency?
Look, corporates in Japan have been very aggressive in stepping up their internationalization, their global purchases. Over the last 6 months, you had more than $60 billion worth of Japanese companies buying international corporations, and you're going to see more of that, particularly in the retail area, in the service industry. That's the new Japan. It's not the old metal-bashing manufacturers that are going overseas, but now it's the service sector that is globalizing aggressively.
Okay, so would you buy into these sectors because of the M&A activity that you're seeing?
Look, I think that M&A activity needs to be evaluated case by case by case by case. On balance, from a top-down perspective, of course, corporate Japan's profit margins on overseas operations are almost 4 times what they are on domestic operations. So generally, the more corporate Japan buys international, the more corporate Japan globalizes, the better the structural outlook for corporate profits.
Okay, so, Jesper, in these times of volatility, you said before that the big, the safety plays are the Japanese yen and Japanese corporates. Does this mean we're going to see Japanese benchmarks higher at the end of this year?
It's quite interesting. I mean, the one issue that you've got, is, of course, this global risk on, risk off. Corporate Japan, the index overall is going to be affected by that. And who knows, macro mangling continues to be in every investor's forefront here. Meanwhile, you do start to see very good value created and future earnings for those who can take a 3 to 5 year view. Future earnings in Japan are going to be very attractive, in my opinion.
Yep, that's what they say. It's cheap right now, especially on a lot of metrics. But let me ask you this. You said Japan is like it was 15 years ago, which is not a good thing. When are we going to get out of this, the doldrums for Japan?
But look, it's quite interesting, because, I believe you're beginning to see the end of deflation. Sayonara deflation is actually happening, and you're seeing it because unemployment is coming down, the employment statistics is pointing up, you do get more job creation, and that's at the end where domestic demand is going to come from.
All right, well, we got to say sayonara to you for now. Until next time, Jesper, thank you for that. Jesper Koll.